get in a little bit earlier on companies that are very fundamentally solid, but just might not have popped up on the radar yet.
Investors are always chasing that next massive earnings beat.
Earnings is a lot of smoke and mirrors. There's a lot of things that they can do to manipulate the earnings and tell the story that they want to tell.
But Marc Lichtenfeld with the Oxford Group explains a much better metric to get in early on the next big winners.
They've only been profitable twice in the last 10 years, yet they generate between about $800 million and $1 billion in free cash flow every single year.
And help you get out of the stocks that might only look good at earnings.
They're reporting profits, but there's $1 billion of cash going out the door.
Don't miss Marc's top 2 stocks to drop right now and his top 2 stocks to buy. Let's dive in. Marc, so great to have you back on the show with a really great list for our viewers today, talking about your 2 stocks that you would drop right now and your 2 favorite stocks to buy now. We talk a lot on this channel about new stocks to add to your watch list, but it is also very important to talk about the stocks that you don't want to have in your portfolio right now. Talk about why it's important to consider the stocks to drop.
You know, every portfolio is going to have a decent number of stocks. Probably the majority of your stocks will be roughly in line with the market. Some will be a little bit above, beating the market by a few points. Some will fall below the market by a few points. Then hopefully you have a few home runs that, really move the needle. But on the other end, there could be some big losers or potential big losers. And so the key to making market isn't always just picking, that one winning stock. It's to make sure you're letting your winners run so that you do allow yourself to have some home runs, but not take big losses. So if you can keep your losses small or get out of a stock before it becomes that big loser, or never even get into a stock that is going to become that big loser, that's the way to make money in the market. Nobody bats 1,000 in the markets. It's really about minimizing your losses while letting your winners run. So anything we can do to minimize those losses, we need to do.
Such a good point for our viewers today. I'm glad that we're talking about both sides of this. And you have some really interesting stocks, a couple of names we haven't talked about yet. So I'm excited to get to your list. But first, I want to talk about how you came up with this list. Earnings season has just passed. A lot of people focus on how well a company did in earnings. What else do you look at to decide whether a company is a buy or a drop right now?
One of the things that I learned very early on in my career is that earnings is a lot of smoke and mirrors. There's a lot of nonsense that goes into earnings numbers, and they can really be manipulated to do whatever the CEO or the board wants them to do. So for example, if they want to pay less taxes, corporate taxes, then they can pull some levers to reduce earnings. It's all legal. They can increase non-cash expenses, things like that. If they want to improve earnings per share, they can buy back shares. That has no, that's no improvement in the business. But if you buy back shares, there's less shares outstanding, same amount of earnings. So that's going to increase the earnings per share. So there's a lot of things that they can do to manipulate the earnings. But there's a number out there, cash flow, which is much, much more difficult to manipulate. Obviously, if a company is committing outright fraud, that might be a little bit different. But even then, cash flow often shows up and signals investors that something is not quite right here, because cash flow really represents the amount of cash that is coming into the company versus the cash that's going out. And it's much more difficult to fudge accounting and manipulate. So that's the thing that I look at. Earnings are great. We certainly want our companies to be profitable. We want earnings growth, but cash flow is what I look at to really understand the fundamentals of the business and how healthy it is or not.
And it's a really successful metric too. I know you are all about the numbers, and you and your team have done a lot of research into cash flow and how it indicates that some of the most successful stocks in the market for the past few decades, really. If you want to check out Marc's latest report with his full research on just how much of an indicator cash flow is on the success of a company, he's got some specific examples. It's really fascinating how well this metric can really indicate which stocks are going to be the biggest winners and which ones could be the biggest losers. You can scan the QR code now or click the link in the description to get Marc's full report right now and really dive into this metric and this research that can help you be a much better investor and pick some more winners for your portfolio. Well, Marc, I'm really glad that you are sharing a few names using this metric today with our viewers. I think we should start today with the 2 stocks that you want to drop based on this metric. What's that first company?
Sure. So the first one is a company most people probably are aware of and maybe have even used. It's U-Haul, ticker symbol UHAL. So they are profitable. Their earnings have been falling. They've been going in the wrong direction for the last few years, but they are a profitable company. That being said, free cash flow is negative almost every single year for the last 10 years by at least $1 billion. So, what that means is they're reporting profits, but there's $1 billion more cash going out the door than is coming in. So they're bleeding money. There was only 1 year in the last 10 that was cash flow positive and only by $100 million. That may sound like a lot of money, but when you're bleeding $1 billion a year every other year, then that's not too much. So our earnings are projected to continue to decline, yet it's still trading at 37 times earnings. But again, losing cash every single year. It has 877 million in cash, but also 7 billion in debt. So this is a company that does not have money coming in the door to grow the business, to pay that interest. So eventually they're going to have to raise money either by a stock offering or borrowing money in selling bonds or taking out a line of credit, what have you. But this is a company that is just not bringing in cash in the door. And every business, I mean, that's really the goal. Yes, you want to have positive earnings, all the different metrics we can look at. But at the end of the day, you need to have cash coming in the door.
Yeah, it's really that basic, looking at those financials going, okay, there's going to be a problem here. You can't keep running down the train tracks and not run into this wall eventually. So really great point on this one. Keeping those facts in mind, all of the financials in mind, thinking about U-Haul and their company, is it really about the economic factors? The housing market's been really in a lull right now. People aren't moving as much. Is that a part of this story? Could that story change as, interest rates and the mortgage and housing story changes? Or is this really a business problem for U-Haul?
That's a great question. And I would argue that it is a structural problem because this has been going on for 10 years. So yes, could an improved housing market help? I think it probably would, but is it going to fix it and plug that $1 billion a year hole in cash flow that has been going on for 10 years? I mean, the housing market was hot in 2016, 17, 18, 19, 20, and they weren't generating cash flow then either. So unless there's some kind of major structural changes to the business, I don't see how even an improved housing market is going to really change things that much.
Yeah, really great point on this company. It's all about the business itself. One last question on U-Haul before we move to the next name, and this is a name that maybe somebody's had in their portfolio for a really long time. Maybe they've just been holding onto the stock for a while, hoping it does something. Just because it's got the name recognition and it's been around for a while, would you still recommend dropping this if you've been in it for a long time?
Yeah, I mean, this is not a stock that I like at all, and I don't believe in holding stocks because you hope things will improve or because it's down and maybe it'll bounce. I mean, if you're looking at the charts and you have a reason to believe that it's on support and there could be a near-term bounce, maybe. I won't argue with you too hard if that's your strategy, but I would definitely have a stop in place if you're doing that. And if you're not a technical trader, if it's just a stock that you've been holding for a long time, then I would just dump it because I don't see any improvement coming.
Great first stock to talk about here, Mark. Let's move on to the second company that you would drop right now.
So this one I'm very, very passionate about. The company is called Strategy. It used to be known as MicroStrategy, ticker symbol MSTR. And quite frankly, I think this company is complete garbage. I'm not mincing words here. Their business model, what they do is they buy Bitcoin, they borrow money to buy Bitcoin and then hold it. Trailing 12 months, they had $4.7 billion in earnings. That sounds pretty impressive, except their earnings come from holding Bitcoin and having unrealized gains. That's not earnings. That's like you or me going to a bank to take out a mortgage. And let's say we make $100,000 a year salary, but we had a $100,000 gain in our investment portfolio. And we go to the bank and we say, well, our income is $200,000. The bank's going to say, no, it's not. And that's what this company is doing. So they have $4.7 billion in earnings or net income, but it's just from asset price appreciation. But the crazy thing is the CEO, Michael Saylor, has said he will never sell the Bitcoin. So there won't be any way to actually ever monetize this if he sticks to his word. Meanwhile, the company is cash flow negative. So cash is actually going out the door because their whole business is basically borrow money and buy Bitcoin. People like the stock because it's a proxy for Bitcoin, but I've been arguing for a long time, if you like Bitcoin, just buy Bitcoin or buy a Bitcoin ETF. There's no reason to own this particular company when they're bleeding cash and their earnings are basically a joke. They're not based on anything.
Really interesting perspective. And like you said, not mincing words. We appreciate that here. We talk a lot about if you are interested in Bitcoin and you aren't comfortable with that market, you want to stay in the regular stock market, how to invest in Bitcoin. Is what MicroStrategy is doing different than the Bitcoin ETFs that you were just talking about, or some of the other Bitcoin related stocks out there?
So basically, they're a Bitcoin holding companies. That's what I was saying. If you like Bitcoin, just buy a Bitcoin ETF that does the same thing. You don't need to be paying all the expenses that go with an operating company, and most importantly, there's no reason that you should be investing in a company where the CEO decides when to buy Bitcoin and borrows money to do it. And keep in mind, they only buy more Bitcoin when it's up, because the times that they can get the investment banks to lend them money or to have a bond offering or a stock offering is when Bitcoin is high, when it's hitting new highs. When it's low, when in the times where Bitcoin has come back in, it's dropped 10, 20, 30%. The investment banks aren't answering the phones at that point. And so they're never buying low. They're always buying high. So I would say trust yourself to buy Bitcoin or the ETF rather than a CEO who is always buying at the high.
Yeah, really great points on this one. And I'd love to hear from viewers in the comments about what you think about MicroStrategy. We have some MicroStrategy fans out there who have gotten some exposure to Bitcoin this way. What do you think of Mark's take on that? Let us know in the comments. All right, Mark, let's move on to the buy list now. Let's talk about the first company that you're looking at as a really good buy right now.
Sure. So I really like Teva Pharmaceuticals. They're a generic drug maker. They've only been profitable twice in the last 10 years, yet they generate between about 800 million and $1 billion in free cash flow every single year. So, this is a company where you look at it and go, well, they're not profitable. You can't really look at a PE ratio because they don't have earnings, yet they're bringing roughly $1 billion of cash in the door every single year. And keep in mind, that's after paying debt, interest on their debt. They're still bringing in $1 billion a year. And free cash flow estimates are expected to rise substantially from $700 million last year to over $2 billion this year. And earnings are also expected to rise, but it was the very positive free cash flow compared to the negative earnings that really caught my attention here.
It's so interesting that you can have a company kind of miss on revenue, but still have really impressive cash flow. It makes this company a good one for retail investors to research a little more and dive into. But I do know some of our viewers out here aren't such big fans of biotech companies.
Sure, and that's a very valid concern, especially with some of those earlier companies that are either pre-revenue or are just getting a product launched for the first time. So the risks can be high. The profit potential is enormous on these especially smaller cap biotech companies, but the risk is definitely elevated. So I have no problem with anyone who wants to stay away from a company like that. Teva is more like a giant pharma company. It's more like investing in a Pfizer or a Bristol Myers. They've been around a long time, big generic drug company. So this is not that. It's still in the pharmaceutical space, and yes, there will be some effect from the FDA and when drugs are approved or not. But again, it's generic. They're not reinventing the wheel. They're not trying to come up with a brand new cure for cancer and Alzheimer's that the fortune of the company is going to rely on. They're selling generic drugs, which is a pretty solid and steady business.
Solid and steady, and it leads to really good cash flow for them. So thank you for this one. Let's move on to the next company that's on your buy list and has that really positive cash flow.
Sure. So this one is in the tech space. It's Marvell Technology. And they're in the AI space, but they're not getting the attention and the love that the NVIDIAs and the Broadcoms and some of the other high flyers are. One of the reasons may well be because they have not been profitable for 5 years, but they've been generating $1.5 billion in free cash flow. Free cash flow is forecast to more than double from $1.3 billion in the last fiscal year, which ended in February, I believe, to $2.8 billion this fiscal year, and then continue to go higher next fiscal year. So, because they haven't been profitable, I think they're just not getting the attention that so many of the other chip companies in the AI space have been because they have been so profitable. But this is a company generating lots of free cash flow. So I think it's a little bit of an under the radar play. If you feel like maybe you're too late to Nvidia or Broadcom, this is a way to still get exposure to that space in a trade that's not very crowded.
It's so interesting to talk about these companies. Both of the picks that are buys based on cash flow, both don't have the greatest, revenue or profitability that you're talking about. When you're an investor and you see these kind of conflicting metrics, how do you decide which one to pay the most attention to? Is the cash flow enough to say, yes, this company is going to do well in the AI space in the future?
I would never buy a stock just based on one metric alone, just looking at free cash flow and saying it's going up, I'm going to buy the stock. You want to understand why it's going up. And if earnings are negative, why are earnings negative? What's happening here? But I do love to see companies where earnings are negative and cash flow is positive to find those stocks that maybe are somewhat ignored by all the other investors because they're looking for those big earnings beats and the things that make headlines during earnings season. And when a company loses 20 cents instead of 25 cents, that's not, that doesn't often make headlines. So that's one of the things that I really love about kind of comparing earnings to free cash flow. And the other thing too is, looking at the free cash flow, if I see that it's a strong trend, that they're generating tons of cash, kind of regardless of what earnings are doing, that's generally a sign that the company is healthy. Often earnings will follow the free cash flow if free cash flow is strong. Eventually that will catch up. So again, another way to perhaps get in a little bit earlier than other people on companies that are very fundamentally solid, but just might not have popped up on the radar yet.
Such an interesting way to look at investing today, Mark. I really love that you're sharing this with our viewers. It's a great topic, and I want to share a little bit more about the research that you've done, because I think what's so interesting about cash flow, the metric that you've just been talking about this whole video, is that it has proven to really show the biggest winners and kind of predict those winners. Talk about that just a little bit, about what people can find if they go and look at that full report that you did.
Yeah, so we go into detail on how looking at cash flow, it's been a very, very strong predictor of a stock success. And probably because, as I was saying, it allows you to get in a little bit earlier than you might have if you were waiting for that big earnings surprise or for a company to turn profitable and then show earnings growth. And we know that one of the biggest factors of investing success is time. The longer you're in a winning stock, the better it is, and the more that it will move the needle on your portfolio. That's really where the big winners come. It's not from just picking that stock that doubles in a year. That's great when it happens, but it's about having that stock that ends up being a 5x or a 10x over 5-10 years. Looking at the free cash flow and cash flow from operations and really diving into the cash flow is what allows you to identify these companies early and allows you to stay in longer. And before most people are getting in, and then when the rush hits, you've been in it for a little while already, and you can ride that wave up.
Yeah, such a great point to get in before others, because it's not making the headlines, like you said. I think such a great way to look at stocks. If you want to look at that report, again, scan the QR code. We have the link for you right in the description. You can get Mark's full report where he explains a little bit more about this metric and gives some specific examples of some really successful stock stories using the cash flow metric. Mark, thanks again for your time today. I love the conversation. I so appreciate having you on and sharing some great information with our viewers.
My pleasure. It's always great to see you. Thanks for having me.
And let us know what you think in the comments. Are these two buy recommendations something that you're interested in? And are these drops something that you are looking to get out of your portfolio too? We always love to hear from you in the comments, and let us know what you think. Thanks again for watching, everyone. And as always, happy investing.